So we'll start from this transfer pricing problem. So this problem was asked in June 2016. We'll start from the required. So there are like three different requireds here. So we'll start from the first one alone. Calculate the incremental profit or loss per component for the group if division M accepts the new supplier's offer. Okay. So if the division M is going to accept the new supplier's offer, what would be the change in price? So I think it would be the buying department buying from outside, and recommend how many components division L should sell to division M if group's profits are to be maximized. Okay, so again he asks us how many units should the L sell to division M. Okay, what is good for the company they're asking. So it's just a 3-mark question. So we'll start from the question top. A manufacturing company, Manco, has two divisions, division L and M. Both divisions make a single standardized product. Division L makes component L, which is supplied to both division M and external customers. Division M makes product M using 1 unit of component L. Okay, so M is the buyer and L is the seller here, and other materials. It then sells a completed product M to external customers. To date, division M has always bought component L from division L. Okay, so all the components are bought from division L only. So they have given the two products details here. So they have given us a selling price, direct material, component that is being bought from L, other direct labor, variable overheads, selling and distribution cost, contribution per unit before fixed cost, external demand, and capacity of plant. Okay, capacity of the plant they have given, and they also given division L charges the same price for component L to both division M and external customers. So the selling price is the same. This is 40 rupees. Okay, $40. However, it does not incur the selling and distribution cost when transferring the goods internally. So this $4 does not get incurred when it is sold to the internally. Okay, division M has been approached by a new supplier who has offered to supply it with component L for $37 per unit. Okay, so they are actually purchasing from the product division M is purchasing from division L at a price of 40, but now there's a new person who's coming and selling at 37. Okay, so this is a much more better rate for division M. Prior to this offer, the cheapest price which division M could have bought component L from outside the group was $42. So earlier the price available was 42, but now it is 37. So 37 looks much more cheaper. It is head office policy to let the divisions operate autonomously without interference at all. Okay, so it is their policy to set anything. So let's start the first question. What would be the incremental profit or loss per component if the group starts to buy from the outside supplier? Okay, so first we'll put it like this. What is the price that is available from the outside? It is available at 37. So what is the cost of producing this product inside? Okay, inside the company. So if you see, if the company produces, it is going to be 12, which is the other material, plus 6 labor, plus 2 variable cost. Selling and distribution cost does not get incurred, so we can leave that. So this would be the cost that is incurred. Okay, and 20. So the contribution, okay, the amount that is profit or loss per unit. Okay, loss to group if unit bought from outside. Okay, so this is the crux of it. Okay, it's an unnecessarily they have to lose this money. Okay, because it only takes $20 to produce a product. Why should we buy that at 37? Okay, that is the reason here. Okay, and the next one is, and recommend how many components division L should sell to division M if group profits are to be maximized. Okay, see, if L could sell it outside. Okay, so we'll put it like this. Contribution if sold externally, okay, and contribution if sold internally. Okay, we'll find out that. So this is going to have a similar kind of information only here. So we need selling price, and we need any other variable cost, and we can get the contribution. Okay, we can get the contribution. So let's start. So they are selling the item at 40 only to whoever it is, right? And the variable cost if it is produced inside, it's going to be this number. Internally, if they're going to sell, it's going to be this number. So again, it's going to be 20, right? It's going to be 20. So just for calculation purpose, I put it here. So contribution would be 40 minus 20. Okay, so the same thing we have to work out for this one. So if you look at here, if they are going to sell outside, they are going to incur all the cost. Okay, this other component, direct labor, variable overhead, also plus selling and distribution overhead, that also they are going to incur. So that's going to be 24. And it is 16. Okay, so okay, so they are going to sell it at 16 here. Okay, so how many units they could maximum transfer? So if you see, the contribution is very good if it is like transferred internally. So all the goods demanded by M. Okay, how many goods are demanded? 1,20,000 units. Okay, so all of 1,20,000 units demanded by division M should be supplied. Okay, should be supplied. So that's about the comment here. So if you want, you can just put it as a comment. So we'll move on to the next one. So let's see the question here. The second question is, using the quantities calculated in A and the current transfer price, calculate the total annual profits of each division and the group as a whole. Okay, so he just wants to find, he just asks us, assuming it's going to be the same current transfer price and policy, tell like what would be the total profit, okay, for the division as well as the group. So we'll start from here. So we have three elements here. One is division L, M and group. Okay, we will work out the numbers in terms of thousands, so that's it's also easier for us to work out. So we'll start from sales. So we'll start from division L sales. Okay, so L transfers everything internally. So he will transfer how much? 1,20,000 units he will transfer, but okay, at a price of what's the current price? At a price of 40. Okay. Additionally, he also sells it to outside companies. Okay. So externally he sells 1,60,000 units. So he sells 1,60,000 units. Okay. And these are the workings. And if you take Division M sells it at 96. Okay, how many units they are selling? They are selling 1,20,000 units at a price of 96, right? So we can first find out the sales. The sales is going to be like this. So as we are using as we are using Excel, we don't need to cut the zeros. It's quite easy only. But when you are doing in paper, pen and paper, if you cut the thousands, it would be like much more easier for you to do. Okay, so we can get the total revenue. Total revenue would be the same number for Division M. For this one, it will be different. Okay, so we got Division M. Sorry, the revenue we got. So let's see the material costs. Okay, material cost is the external material cost is 12, but how many units are being produced? Okay, see the total number of units produced is 2,80,000, right? 2,80,000 units are produced. And what's the external material cost? So external material cost is for L, it is 12. Okay, there's no internal transfer cost for them. They are not purchasing anything, but they also have labor cost at $6. They have selling cost will not be for internal department. Okay, internally if they transfer, there's no sales cost. So again this number will flow to 1,60,000. Okay, so we'll first solve these. Okay, we have a variable overhead also. We have variable overhead. Variable overhead is $2. Selling overhead is 1,60,000 sold outside into the $4. So we got the numbers. So we can actually solve these and get the costs. So let's start solving them. So when you are going to solve, be very clear with the what was the rules you studied in the theory. Okay, here, then solve them. So we don't need to have total variable cost. We'll remove it. We'll just say the contribution. So contribution is sales minus the sum of all these expenses okay, so it comes to 4,96,000 here. And we also have the fixed cost. Fixed cost is 5 lakhs. So it would be 44,60,000. So that we got. Let's do for the other division M. Okay, division M, external material cost. So they are having only 1,20,000 units. 1,20,000 units. External material cost is going to be 17. we'll take this number and we'll put it in one step higher. Internal costs are 1 lakh. Okay, it's going to be component L. Also, we will just have it as internal transfer cost. It is bought at a cost of 40. Then we have labor cost, which is $9. And variable overhead, which is $3. And sales cost is $1. So we can take all these numbers, we can put it here and get the answer. So we'll get the contribution. So also the fixed cost. Fixed cost, if you see, it is 2 lakhs. So our profit comes to 29 lakh 20,000. It comes to that amount. So the division profit, okay, they are also asking what is the group profit. So group profit, we can actually put it here as a simple line. So group profit is going to be so this will be the group profit here. Okay, so we have done with the B part of the question. So let's go to the C part of the question. Discuss the problems which will arise if the transfer price remains unchanged and advise the divisions on a suitable alternative transfer price for component L. Okay, so what would be the problem if the transfer price remains unchanged? Okay, that's going to be a problem. So it is a discussion based question. Problem if transfer price is unchanged and another would be advice on the suitable alternative transfer price. Okay, so these are the questions here. So for at least for discussion, we need these items. Okay, for discussion purpose, we might need these items. So we'll just have them and we'll delete it after our discussion is over, right? See, the current transfer price is 40 and some other companies are giving at 37. Okay, so division M will purchase all of the 1,20,000 units from the external supplier. Okay, this will cause the group to lose this will cause the group to lose, okay, the group will lose $17 because if they purchase from outside it's $37. The production cost itself is only 20. Okay, so they will lose $17. This will cause the group to lose 17, okay, or $17 per unit, right? So what should we do? Okay, what should we do? Okay, as the variable cost of the unit itself is just 20 or $20. Okay, at $37. Okay, so we got 2 points here. So this will cause a huge amount of loss for the company. In terms of units, you can also put that the total loss if bought from outside would be, okay, you can just multiply it and show 1,20,000 into 17. That would be the loss. So let's check how much is that amount. That comes to this number, so we'll put that. Done. So that is going to be the total loss if they are buying from outside. So that loss seems to be substantial. Okay, so advice on what should be done. Okay, advice on what should be done. See, division L should reduce its price. Okay, it should reduce its price, but by how much? Okay, how much? See, we have to find out first what is the contribution they are getting. Okay, so that also we have done here. See, the contribution that they get, division L gets by selling internally, they get 20. Okay, if they sell externally, they get 16. Okay, they get 16. So there is a high chance, okay, there is a good chance that even if they get the same external contribution, that is like still fine. Okay, so they can reduce their price by the $4. Okay, and they can reduce it to 16. So we can put it like this: should reduce its price to 40 minus 4, 36. Okay, to 36 they could reduce. Okay, they can reduce to this price. Okay, not should, we can put it as can. Okay, because, so we have to substantiate why it is, because the contribution they earn externally is 16. Okay, is 16. Okay, and variable cost of production is $20. Okay, is $20. So see, because the contribution they earn, or we'll put it as lose. Okay, lose if sold internally. Okay, if sold internally, they lose $16. Okay, so because they are losing, if they have sold outside, they could have got it there, that 16, but if they sell it inside, they are losing 16. The cost of production itself is 20. So totally, hence 20. Okay, this is another way of finding out. 20 plus 16 equals to $36. Okay, $36 can be set as the transfer price. Okay, so this can be set as the transfer price here. Okay, so they are buying. So division M, okay, can buy externally at 37. Okay, and division L can easily match the same price. Okay, so transfer price could ideally be at 37. We can just match what the external supplier is giving. Okay, so that's about this answer. I think let this points be here. Okay, so that you can easily connect it with here and you can write the answer. Okay, so that's about answer C. So hope you guys got an idea. See, the mark is 6 marks, so you have to validly argue for 6 points. Okay, so if you see here, we have argued for 1, 2, 3, 4, okay, 5 and 6. So even though this point and this point seems to be similar, okay, the way we argued is like quite different. Okay, here we argued it in a different manner, here we argued in a different manner, so we will easily get 6 points. Okay, see here also we wrote another 3 more points, so it's 1, 2 and 3, right? So totally we have written around some 9 points, 9 valid points, so we'll easily get the 6 marks. Okay, so that's about this concept here and this sum here. So transfer pricing is not easy. Okay, it might look easy, but it is very complex. In terms of workings, it's like very less workings, right? It is not something like an ABC problem where you have to keep on working, or it's not like very lengthy procedural wise, but it is like very thinking oriented. That is the problem with this concepts. So we'll start from another transfer pricing problem. So this problem was asked in June 2018 exam, ACCA exam. And the question is here. It has a lot of requirements. Okay, we'll start from the first one. Under the current transfer pricing system, prepare a profit statement showing the profit for each of the division and the portable garage co as a whole. Okay, so for both divisions and for the group you have to show. Your sales and cost figures should be split into external sales and internal division transfers where appropriate. So you have to show the split also wherever it is possible. So we'll start from there and then we'll move on to B, C requirements. So we'll start from here. The Portable Garage Co. is a company specializing in the manufacture and sale of a range of products for motorists. It is split into two divisions, the battery division and the adapter division. Division B sells one product, portable battery chargers for motorists, which can be attached to a car's own battery and used to start up the engine when the car's own battery fails. Division A sells adapters which are used by customers to charge mobile devices and laptops by attaching them to the car's internal power source. So recently, Division B has upgraded its portable battery so it can also be used to rapidly charge mobile devices and laptops. The mobile device or laptop must be attached to the battery using a special adapter which is supplied to the customer with the battery. So Division B buys the adapters from Division A. So that's a concept here. So ultimately we have come to the concept. The concept is Division B, okay, is the buying department and it buys from Division A, which also sells them directly to other companies. So Division A also has a external customer base. Okay, so these are the data. Selling price for each portable battery including the adapter is $180. Cost per battery is given. The adapter purchased from Division A is $13. Other materials from external supplies is $45. Labor cost is $35. Annual fixed overhead is it is 5,460,100,000 or 54,60,000. Annual production and sales of portable batteries is 150,000 or 1,50,000, and maximum annual market demand for portable batteries Okay, so the earlier one was production and the second one was demand. The demand they have is 180,000 or 1,80,000 units they have annual demand. Okay, but the production is only this much. So we don't know whether they have the capacity. See, capacity is not given, so we have to assume that this is the capacity. Okay, or the data has to be given somewhere else also. Let's see at division A. Division A's selling price is $13 to division B. Okay, to external customers they sell it at $15. The cost of adapter is given, material and labor. Annual fixed overheads is also given. Okay, and the current annual production capacity and the sales of adapters both internal and external. So their total capacity is 350,000. 300 and sorry, yeah, 350,000, 350,000, yes, or 3,50,000. And what is the maximum external demand they have? The maximum external demand they have is 200,000 or 2 lakhs. So in addition to the materials, labor costs above, division A incurs a variable cost of $1 per adapter for all adapters it sells externally. So if they sell externally, they are going to incur another $1 more, which is not given in the problem. So currently head office purchasing policy only allows division B to purchase the adapters from division A, but division A has refused to sell division B any more than the current level of adapters it supplies to it. So they are not trying to increase the sale here. Okay, so if you look at here, they totally have 3,50,000 capacity and they sell 2 lakh outside, and the balance 1,50,000 they are selling it to the internal division. Okay, so they are not willing to sell or give more than that. The manager of division B is unhappy. He has a special industry contact who he could buy the adapters from at exactly the same price charged by A if he were given the autonomy to purchase from outside the group. Okay, so he could actually buy the goods at the same price itself from outside. Okay, so should we allow him or not? That becomes another question. Then after discussion with both of the divisional managers and to ensure that the managers are not demotivated, head office now agrees to change the purchasing policy to allow division B to buy externally. So they can buy externally also, provided that it optimizes the profits of the group as a whole. Okay, provided the profit of the company goes up, then they are willing to allow it. Okay, so that's about the concept here. Let's start with the question. So we shall start here. So we'll put the workings here. Division B and A. Workings we'll put here. Right, so we'll start. So we'll first do with division B. Okay, then we'll go to division C. So division B is selling only externally, and how many they are selling is 1,50,000 units at a price of 180. Okay, so that is external sales. And then internal sales are not there. The variable cost, if you see, they have variable costs such as adapters purchased from division A, so that is there. So internally transferred cost is going to be 1,50,000 units into 13. Material cost is going to be 45. Labor cost is going to be 35. and other costs of external sales, okay, that's not available for this department. And is there any fixed cost? Yes, there is a fixed cost, so we'll put that also. So fixed cost is going to be, okay, we'll do all the numbers in terms of full numbers itself. We don't need to cut anything. So it is going to be 460,000. Okay, so let's take all the numbers and we'll get the answer. So let's get the contribution here. So we got our division B profit. Let's get division A profit. Now let's work out for division A. So division A has external sales and how many sales they have. So externally, if you see, they are selling 2 lakh units and at a price of 15. For external customers, they sell at 15. For internal transfers, they are totally selling. So here we have the internal transfer price. So that is 13. 1,50,000 units into 13. So totally put together, they are producing 3,50,000 units. Okay. They are producing 3,50,000 units, and that is going to cost them around, material is 3, labor is 4, and they have other external cost such as selling cost, okay, other variable cost he says. So that is going to be only for the external sales. So for external sales alone, it's going to cost, and that comes to $1. Okay, $1. Is there a fixed cost? Yes, the fixed cost is there, so we can have to put that also. So let's find the contribution. So contribution is adding these numbers and deducting these numbers. So we got it. And this is our profit. Okay. So what would be the total profit? So the total profit, if you want, you can just have to add all the numbers. You will get it. You add this number plus this number. All numbers column wise, if you add, you will get the answer. Okay. So that's about it. So that's about the concept here. So we got our profit statement. So this part of the sum is over. So we have to move to the second part of the sum. So let's see the second part. The second part is, assuming that the new group purchasing policy will ensure the optimization of group profits, calculate and discuss the number of adapters which division B should buy from division A, and the number of adapters division A should sell its external customers. Okay, so they are giving a free hand to both the companies, okay, both the divisions. So what should they do? So let's see, like what's currently they are doing. Okay, so let's start from division B angle. So division B says that they could easily buy the units from outside, okay, from outside at the same price, okay, at the same price. So they say that they can buy at $13 easily. So they can buy at $13 easily from outside, and they also say they can buy uh, all the units. Okay, that's what they have put. So they are not telling like how many units additionally they could have. Okay, the current production is 1,50,000 they say, but above that how many units they are going to sell, it's not told. Okay, so they could actually buy all this from outside also. They could buy all this from outside also. Okay, that's a chances there. So division A, okay, we'll think about division A. So this price would be the maximum price. They will not pay more than this 13. Okay. But let's see how much price that can division A give. Okay. See, division A's internal selling price is going to be this much, or we'll find out like this. What is division A's internal contribution? Okay. So they are selling this unit at 13. Okay. And what is the cost they are incurring? Their cost they are incurring is 3 plus 4 alone. That alone they are incurring. So let's see the answer. 6. Okay. Internally, if they sell, they get 6. Let's see what they get outside. Outside price is 15. It's going to be 3 plus 4 plus 1. Okay, because that's going to be the like sales cost or something. So if they sell outside, they are getting one more dollar extra. Okay, one more dollar extra they are getting. Okay, and this is why they don't want to lose the sale. So the opportunity cost, if you say the opportunity cost of selling to division B is this $1. Okay, so they don't want to sell this. They don't want to lose this $1. Okay, see, hence that's the reason why external sales becomes a priority. Okay, so division A should first sell the external people. Okay, they have to sell the external people. So externally they have to sell 2 lakh units. Okay, or else you'll put like this: total production capacity of, okay, of division A. So the total capacity is 3,50,000. 2 lakh is the external sales. So maximum they can sell 1,50,000 units. Okay, and they don't want to sell anything more than that. If it has to be sold, okay, they will sell at they need at least $14. Okay, they will need at least $14. So we can put like this: any unit to be transferred beyond 1,50,000, beyond 50,000 can be transferred at a price of, okay, at a price of $14. So how did we arrive at that 14? Okay, see, if we sell, see, the total making cost is 7, sorry, the total making cost is 6, okay, and the opportunity lost is going to be 1, okay, not 1, it's actually 7, okay, they'll lose 7, sorry, making cost is 7, sorry, production cost is 7, and opportunity lost not selling from the outside guy is 7, so totally they would lose, it would be better for them, okay, it would be better for them to charge 14, okay, if it's at 14, I don't think it's much of a problem, they can supply any number of units, okay, even the entire units can be supplied. So let's see the last one. The last one is calculate, okay, he's given an assumption, but we don't know whether this assumption is for this question or for this question. Okay, mostly it is for this question only, it would be. Let's see. Calculate and discuss what the minimum transfer price would be for any additional adapters supplied above the current level by division A to division B, so that division B can meet its maximum annual demand for the new portable batteries. Okay, so what he asks is the minimum price. Okay, the minimum price he wants. So okay, so the minimum price would be like this. The making charge itself is going to be $7, so that's what we put it in the last statement here, $7, and the contribution lost by not selling outsiders is 7, and put totally the new transfer price has to be at 14. Okay, so that's about this problem. Okay, hope you got an idea about how to work out this problem. This problem working out wise, it's like straightforward in the requirement A. From requirement B onwards, it becomes a little bit complicated, but you have to work out, there is no other option, okay, because you might get this kind of a question in a exam and you have to answer it, okay. So that's about the concept here. We'll end the transfer pricing.